Welcome to this recorded A&A session on utilizing effective analytical procedures. My name is Dacey, and I will be serving as your presenter for this abbreviated session on considerations that you can employ when utilizing analytical procedures in your organization. No CPE session would be complete without adding a disclaimer that the thoughts expressed in this section are mine and mine alone, and are not necessarily the views of Withum, Smith & Brown. As always, any of the content discussed in the session should be carefully evaluated by you and applied based on your organization's facts and circumstances. So with that, let's get the show on the road. Before we get into the nuts and bolts of applying effective analytical procedures, let's start today's session by talking about why applying analytical procedures should be important to your organization. First, analytical procedures can serve as an effective management tool, and if incorporated into your monthly processes, can help identify operational trends and can highlight unusual transactions, resulting in a more timely investigation. Second, tracking analytical procedures can demonstrate good governance for your organization, which can be particularly important when trying to obtain financing or exploring an exit strategy for your organization. And finally, analytical procedures provide important evidence to the audit team when they are conducting their year-end financial statement audit. So with that as the tee up, let's get started with the actual session. This slide provides a concise definition as to what is meant by an analytical procedure. The process for using an analytical procedure is to, number one, develop a reasonably precise expectation that is determined to be reasonable or probable. Once we've done that, we then compare that expectation to the actual result. And if there's a variance outside the expectation that's deemed to require additional investigation, we perform that investigation. We describe what the nature of that investigation is, and we describe the results of that investigation, and that should all be documented. So to recap, the key to a successful analytical procedure is to first develop a reasonably precise expectation and then perform requisite comparisons of the actual results to that expectation. If we think about the concept of plausible or reasonable or probable when evaluating relationships, assuming a consistently applied accounting methodology, it's reasonable to conclude that period-to-period comparisons adjusted for current expected changes would be considered to be a plausible relationship. Regarding the relationship between different financial statement line items, it's important to note that an account that's dependent on another account you're evaluating is not considered to be a plausible relationship. So let me illustrate this. If you were comparing the relationship between commission expense and sales revenue, you shouldn't reach a conclusion that revenue is appropriate by evaluating the change in sales commissions. However, you could conclude that sales commissions are reasonable by evaluating revenue because sales commissions are a function of revenue. As it relates to relationships between financial and non-financial data, revenue might be significantly influenced by transaction count or customer account. I used to manage a Burger King when I was in college, and that's an example of looking at customer counts. That was a big deal as far as managing a Burger King and the revenues associated with a Burger King. Customer count mattered. So that's a non-financial data item. If we think about key performance indicators, you could look at things like contracts signed per month or qualified leads or time to deliver on a performance obligation. Like years ago, Domino's, as an example, said we'll deliver pizza within 30 minutes, or you get your pizza for free. That was a key performance indicator as it related to Domino's. And if you'll notice, I'm using a lot of references to food because I guess I'm hungry, but that's life. And then finally, transaction count, which I just mentioned, that's another example of a key performance indicator. If we think about reasonableness testing, think about interest expense as a percentage of average debt. That's a perfect example of a reasonableness test. So let's move on. Now, as we look at this next slide, the first two bullets more or less recap what we've just addressed. But now let's talk about precision. To address the importance of precision, An example of what lacks precision would be a statement like, well, since revenue increased, the increase in accounts receivable is reasonable. That's not real specific. That's just very general in nature. And that's not going to give you a lot of comfort from an audit evidence perspective that your analytic is precise enough. To use analytics as audit evidence, the audit expectation needs to be reasonably quantified. There needs to be a precision level associated with it. If you look at the fourth bullet where we're talking about disaggregation, that's a key concept also when it relates to analytical procedures. Disaggregated data provides for more of a granular evaluation than a high-level flux analysis and provides more reliable support when evaluating data. So finding an error, as an example, or an unusual transaction that occurred during a specific week is much easier to find than finding that same error if you're looking at an entire year's worth of data. So that's what we mean about disaggregation. We're taking data and we're breaking it down into smaller component parts. Instead of a year, we're looking at months or weeks or quarters. That's disaggregation. As far as reliability is concerned, that's important because you need to have reliability of data in order to form a reasonable expectation. So as an example, independently sourced data outside the entity is often more reliable than internal data. Data that's developed internally, you want to look at that last sentence of the fourth bullet. Strong internal controls serve to support internally generated data. The better the control is that speaks specifically to the precision aspect of a data measurement, the better off you are. So having good controls can lend itself to reliability of data. So as we look at this next slide, example sources for developing or starting to develop expectations, you can see we have several examples of how to go about doing that. When we look at the first item, budgets and forecasts, these are often a good starting point since there is typically a process used to develop these reports, and having that process lends itself to reliability. So think about budgets and forecasts when you're doing analytical procedures. Using data that's already occurred can also serve as a good starting point for developing a precise expectation for an analytical procedure, like a historical shipping log or a transactional log. But when we're looking at these historical reports, and as an example, like archived weather reports, they might also provide good information depending on the nature of the entity. So as an example, a golf club can expect to have an increased customer count during favorable weather. So looking at the weather and understanding what the weather forecasts are for an upcoming period of time might lend itself to developing a pretty precise expectation as to what kind of revenue from that a golf course might derive. To effectively place reliance on data used for developing an expectation, it needs to be tested and evaluated for completeness and accuracy. Which brings us to the next slide. So how exactly do we go about testing reliability of an expectation source? So I give you some examples here. So if you look at like budget and forecast, for example, we might do what's called a retrospective review or a look back review of prior developed budgets or forecasts, just to get a sense as to how management's estimation process is and how their historical process is with respect to developing a budget or a forecast can lend itself to reliability of those budgets and forecasts in the future. Having a process to reconcile shipping logs to inventory movement or sales transaction counts can also be strong support for completeness and accuracy of something like a shipping log or a transaction log. What's important to note is if you want to place reliance on data used to develop an expectation, there really needs to be a process in place to evaluate the completeness and accuracy of that data. So now let's look at this example. I wanted to give an example of how to put together a revenue expectation. So let's take a look and go over each one of these bullets. So we have this company, ABC Company, which is a wholesaler of sneakers, and they have a December 31 year end. ABC had sales of $10,000 for the month ending January of 2022, and the percentage of year-to-date revenue at that time was in line with prior years. So this company was pretty good. They did trend analysis, and they understood that uh, using a $10,000 sales number as a starting point or a benchmark was probably a pretty reasonable thing to do because it was in line with prior years when looking at trends in general. The company had a price increase or a sales price increase of 9% starting in July of 22. So every one of their sneakers got marked up not an additional 9%, and that was the average selling price for those sneakers. ABC gained 2 new customers in September, and they comprised approximately 4% of annual revenue, and that was based on doing an evaluation of those 2 new customers when compared to end of year revenue. 4% seemed reasonable, and they had no loss of significant customers. So we have a bunch of different things that are happening here. There are different variables, and each one of these variables is going to go into the development of an expectation. As we look at this next slide, we take that data from the previous slide and we map it out as far as trying to arrive at an expectation. So we start out with our January 2022 revenue as an opening benchmark, which we deem to be reasonable. We take our July 2022 price increase and we affect that for January to January 2022 to estimate how that would impact January 2023 revenue. And that had a $900 impact, or 9% of $10,000. We then take our 2 new customers and say, what kind of impact would that have? So it represented 4% of the company's total sales based on a comparable period of time for all the customers. So we say that has a $436 impact on January of 2022 sales to arrive at an expected sales revenue for January 2023. And then just by doing some math, we get to $11,336. Now that's a way to develop an expectation. There are different ways to develop it, but I think the important message point from that is have it documented, have a rationale, and develop a process and have that process in place. And I think that'll help you demonstrate good governance. So now, as we go to this next slide, let's look at the concept of adapting or revising disaggregated expectations for changes. So this is an important aspect of analytical procedures. And what's nice about doing disaggregated expectations, again, we're not looking at just monthly revenue or total revenue. We're looking at revenue by month. And as new conditions occur, we take those conditions and we map them out to revise our expectations for the remainder of the year. So that's kind of a reasonable process in place in order to develop an expectations on a disaggregated basis. I would recommend having a process in place that best captures the effects of the changes and conditions for your organization. So to take the example that we previously had, we developed an expectation for January. We're now developing an expectation for May using much of the same criteria. So we start out with an opening benchmark, May 2022 actual revenue, and that was $23,000. We looked at it and we said, if you look at trends, that's probably a pretty good place to start in developing an expectation. We then take the same 2 variables that we had in place. There was a price increase in July of 2022, and that would have affected May of 2023. So that's another variable that we take into account when developing an expectation. And we gained 2 new customers comprising 4% of revenue. So those were also in the January example. But now we add 2 additional items. We add an additional item that company-wide revenue increased another 7% starting in February of 2023. So since that price increase occurred in February, it certainly impacts May. And ABC lost a significant customer in March of 2023, comprising 1% of total revenue. So now with these new facts, we just map it out in order to come up with an expectation. We start with our May 2022 revenue as a benchmark, and then we adjust it to arrive at a May 2023 benchmark. And we leave a trail as to how each of the different conditions that we took into account affect that expectation. So this is a fairly comprehensive way in order to develop an expectation for your company, and it kind of revolves around having a solid process in place. And you could do this for revenue, you could do it for different types of expenses, but I thought it was a good idea just to kind of illustrate this for revenue, because that is something that companies are concerned about, and they want to know changes in trends and things like that. And it just requires more of a holistic view as it relates to your company, to make sure that you're capturing all the relevant information to develop a fairly precise expectation. So now, if we go back to our three-step process that we talked about early on in this presentation, process number one was develop what we believe to be a reasonably precise expectation. Once we've done that, we compare that expectation to actual results, and then that brings us to step three, evaluating and investigating differences. If there's a variance outside of expectations that's deemed to require investigation, and you're going to have to define that. Once you define it, what you're going to do is you're going to investigate and document the nature of the investigation, the results of the investigation, and your conclusion as to the overall reasonableness of the balance. That's essentially the process. So I wanted to bring up a few thoughts for the auditors in the room, okay? And this can apply equally well to the other members in the room who are in private industry. Couple of things. Under auditing standards, if you have a significant risk item, relying only on evidence from a substantive analytical procedure is not sufficient. There's a thought process in professional standards that if you have a significant risk item, you really need to test the details of that significant risk item, which means you have to actually look at underlying prima facie evidence related to that. It's not as simple as just doing an analytical and seeing whether the analytical is reasonable. Now you could do both. I mean, that's certainly fine, but you can't just do the analytical. That's not sufficient if it's a significant risk area. So one might say, well, under auditing standards, revenue is always a significant risk area. Well, that may or may not be true. There may be aspects of revenue that's a significant risk area, like a new customer, and that may not extend to every aspect of revenue. So you have to kind of pick and choose your shots here as to what you're deciding is a significant risk. But the message point is, if it's a significant risk, you have to do a test of details. You can't just do a substantive analytical procedure. Now, the second point, planning materiality, which is a concept that every auditor understands. We do a calculation at the beginning of an audit where we quantify the amount of error that we think is acceptable to be included in a set of financial statements without them being considered to be misleading. So once we do that calculation, the understanding that people should have with respect to analytics is the lower the planning materiality, the more precise the expectation needs to be in order for the substantive analytical procedure to be considered to be effective. If there's a higher materiality, there's a little bit more latitude in the world of auditing as to the level of variation that you can have. But if you're having a lower planning materiality, the expectations need to be more precise. Now, for sufficient levels of precision, analytical procedures result from appropriate support to propose an adjustment. So what I mean by that is, if you have something like an accounting estimate, if the precision is precise and reasonably precise, you could actually record an accounting adjustment based on the results of the analytics, because accounting estimates by their nature have a little bit of flexibility associated with them. There's not an exactitude to an accounting estimate. So you don't say our allowance for doubtful accounts, we're expecting and it's going to be $1,050.42. You don't see that. There's usually a rounding convention associated with an allowance because it's an accounting convention. And then just carefully consider those relationships that exist. Um, and just make sure that if you're using an account relationship to measure the appropriateness of another account, you need to make sure that the account that you're using as the benchmark isn't dependent on the other account. And if I go back to the revenue and sales commission example, sales commissions are dependent on other accounts like revenue results. It's not the other way around. So if you want to evaluate revenue, you can't say my revenue is expected to be this much because I paid this much out in sales commissions. That's just not a reasonable way to think about it. You have to think about it, but you could think about it the other way. If you're evaluating the reasonableness of sales commissions, you could say, well, my revenue is my revenue, and sales commissions are a function of revenue, and that's a reasonable basis in order to evaluate the reasonableness of recorded sales commissions. So just be mindful of that. And then the last thing I really wanted to talk about before we say goodbye to each other is I wanted to provide some resources for performing effective analytical procedures. So if we start with some of the professional standard resources, you look at things like the AICPA U.S. auditing standards. The code reference there is AUC 520. If you Google that, you can find those standards. If you need a copy of it, reach out to your engagement team. They can print it out. We have a service that has all the auditing standards, and we can certainly provide you with that. If you're in the public company arena, that you look at PCAOB auditing standard AS 2305. That's all public information. There's resources for auditors, and auditing standards are part of that. You can just click on, go to Google and click PCAOB auditing standards, and it'll take you right to a website in order to allow you to find that information. AICPA audit guide and analytical procedures, again, that may not be as easy to find independently, but if you need a copy of that, reach out to your engagement team. Just say, hey, I'd like to get a copy of this to do some reading and get a better understanding as to how to employ analytical procedures. Our teams will get it for you. That's really not a problem. Company internal data, that's always a good thing to look at. I mean, let's be honest, transactions that are in a financial statement, they are all internal data. So you want using that data to come up with reasonable expectations, looking at things like trend analysis and the like. That's always good information to use in order to employ an analytical procedure. Google. We all use Google to investigate a bunch of different things and try to get information. Think about the aspects of economic conditions or the like that are relevant to your company. Do some Google searches and see what kind of information's out there. I mentioned weather reports earlier. Like that's all public information. If you want to see the relationship between the weather and the amount of revenue that you derived on a given day, you could put those kinds of analyses together, and Google's a good starting point to do that. Industry periodicals, and they'll give you information on overall changes within your organization that you might expect based on the industry that you're in. Those are all good things to look at, and a good source of information to develop aspects of performing analytical procedures. And then finally, Withum has a central analytics group. This group is really well versed in powerful data analytics tools that are out there. They use them all. We have data scientists in that particular group. They are well versed in using these tools, and if you ever want to learn more information about using a data analytics tool, which will help you identify anomalies, transactional anomalies within your organization, just give your team a call, and they can set up an appointment for you to have a discussion with our analytics people, and maybe they can help you put together certain analyses and the like. So if you're interested in that, contact your engagement team member. So with that said, that really concludes our time together today. I'd like to thank you for your time, and I hope you all have a fantastic day. It's an interesting question. I think it's really a matter of having a good process in place. So if you're developing an analytical procedure related to the relationship, for example, between customer count and revenue. Having a process in place to count the number of customers or transactions that you have in a given day, having reconciliation processes in place to understand the relationship between the amount of the amount of transactions that you have and the amount of revenue that you record. I think that's all important stuff to have. So I think it comes down to process.